Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles podcast. I'm also the founder at Family Office Association. Well, I'm really excited about today, not just because I get to talk about crypto digital assets, although usually that is something that I really enjoy. I've actually have not done as much on that is long form that goes deeper than just Bitcoin and cryptocurrencies. But this week, it seems like I'm punching them out like there's no tomorrow. So we're going to focus broadly about the digital asset ecosystem today, but we're going to have more of a focus primarily on DeFi and NFTs. DeFi has the potential to democratize finance the same way that the internet has done so for information. Just like the internet in its early days, DeFi is messy and completely open platform of innovation with some of the most incredible intellectual capital behind it. It's experiencing the same kind of explosive growth of the before mentioned internet experienced early on. DeFi could do to banks what the internet did to newspapers, radio, and television. And it's much, much more than that. And the total addressable market of banks is far larger than that of traditional information providers. We're also going to do almost as deep of a dive into NFTs and cover other subjects. We'll probably go pretty close to 2 hours. This will be long form. Our special guest today is very simply known as Tasha. I highly recommend you learn about her the same way I did, of course, Twitter, where else? And you could follow her at Tasha, that's spelled TASCHA labs.com. So that's how it would be pronounced and spelled on Twitter. Tasha, welcome to the show.
Hi, Angelo. Glad to be here.
Thank you. Let's get right into it. You stated that Ethereum will be the new government bond. What did you mean by that?
Yeah, so if you look at government bond, that's what we traditionally in the financial world call the benchmark asset or risk-free asset. Now, where does that risk-free come from? We know that no investment is truly risk-free in this world, right? Tomorrow, there can be an asteroid hitting the Earth and we all die. But the thing is, treasury bonds, especially the US treasury bonds, is basically backed by the largest economy in the world, right? So the treasury bonds is backed by the government revenues from the largest economy in the world, and the government takes a cut as taxes from the annual proceeds of this economy. So, by and large, this is considered probably the safest asset in the world. Now, you can also say, oh, this is backed by government because government can issue this currency. That's more of a recent rendition of why this has become risk-free. But traditionally, really, it's a risk-free asset is because it's backed by a reliable proceeds from the largest economy in the world. Now, if you look at the staking yields from the so-called proof of stake layer one blockchains, such as Ethereum, you can draw a pretty adept analogy from there because you think about Ethereum is this ecosystem, this blockchain ecosystem where, all sorts of apps or dApps can be run on this platform. And Ethereum, for every transaction you make on the Ethereum, you need to pay a transaction fee. So Ethereum is essentially take a cut about on the economic activities that's happening on chain on the Ethereum platform. Now, right now, Ethereum is still proof of work, just like Bitcoin. But, I think by the middle of next year, optimistically speaking, we will be transitioning to a proof of stake system. And now you can already stake the so-called ETH 2.0, from some of the staking services. But essentially what this change means is, as a staker, basically, so the proof of stake, just briefly how this work is, you have a blockchain system where you need people to verify the transactions that are happening on chain, right? And so in the proof of stake system, you call these verifying nodes the staking nodes or the verifiers of the blockchain. So in order to keep the verifiers honest, the chain requires that, if I want to be a verifier, I need to put up some assets as a stake and make sure that I have a skin in the game. And if I do not make honest verification, if I try to mess with the system, then my staked asset will be confiscated. So that's the idea. So it's a way for people to participate in securing the blockchain. And by providing this verification service, you get a return as a verifier. So that is how the proof of stake system works. And for Ethereum, once they move to the proof of stake system, part of the transaction fees that we just talked about, taking a cut on the Ethereum economy, right, by the blockchain, they will be used to compensate the stakers or the verifiers. So essentially, you can think of it as a staking yield. It's the same thing, not exactly the same thing, obviously, but it's an analogy as if you are buying a treasury bond, because this is, as far as the Ethereum economy is concerned, this is the safest layer of yields you can get on the Ethereum economy. Now, obviously, the Ethereum economy or any other layer one chains are all pretty small these days, right? So we have the entire crypto system market cap is about 2 trillion. So it's still pretty small, but it's growing really fast at a rate of 200 to 300% a year. So you can imagine, 10 years down the road, a lot of the economic activities that we see in the quote unquote real world today have been moved on chain. So this on-chain economy gets bigger and bigger. That means layer one chains like Ethereum and some of the layer two also, going to be participating in a similar way in a proof of stake system. You are essentially, as the infrastructure, the platform, taking cut of the economic activities happening on their platform. And as the verifier or as the staker, your staking yield is basically the, one of the safest yields you can get from the blockchain economy. So in that sense, there is an analogy between the staking yield and, buyers of treasury bonds. So in that sense, and also, the point I was trying to make is that you see all sorts of other financial products that are being invented as we speak on blockchain, the so-called DeFi, right, that you just mentioned at the beginning. A lot of these are also getting their yields based on these, staking yields from the layer one systems, including Ethereum and other chains like Solana, Avalanche, Phantom, Terra. These layer one chains, they all like shifting to the proof of stake system. So in that sense, this layer is going to provide the so-called risk-free return layer of the blockchain economy, just like the US Treasury did to the traditional financial system.
Yes, what I'm going to do is give a little bit of context to my audience. A lot of people in the family office community, this is still it's coming at them like a fire hose. One, I would recommend to people, I learned it, you could learn it. Now, I put in a lot of hours. I don't think you have to put in as much, not just because you're all smarter than me, although that's probably the case. You have to look at it as this is a tremendous opportunity. The world is changing. You have to dedicate some time to understanding it. Do you have to be an expert on every little nuance? And we're not going to go too technical today, but layer one, layer two, layer three, what's proof of work, what's proof of stake? You should have an overview of what that means, and you can learn that relatively quickly. But here's the big picture. What a lot of you have cash, A lot of you have bonds that are underperforming and per inflation underwater, and gold. So basically 3 assets doing horrific. And is there an opportunity to reposition some, I'm saying some of it, towards something in the digital asset community that could be far, far more attractive? Now, eventually the institutions are going to come in, and it's going to be tremendous in some ways. Some of the rates that we're talking about shortly may come down because that volatility comes down, but they're concerned about ESG. We may get to a little bit of that shortly, as well as regulation, but the regulation's kind of happening quickly. This is a tremendous opportunity. Don't put your head in the sand. Don't assume that you can't learn it. You probably invest in many things that you don't completely understand. You need to know enough to form a thesis and make a decision to move forward. My part 2 of the question, Tasha, which relates to what you just said, is related to that prior question, staked, and maybe you should explain that, but staked Ether or proof of stake asset of a dominant blockchain will replace US Treasuries as a risk-free asset in any portfolio. For those that don't know, this really goes to the promise of DeFi, but you may need to explain staking and how that all interacts to what we're talking about.
Yeah, so like I said earlier, the entire, not the entire blockchain system, obviously, as we still have Bitcoin, which is running on proof of work, and that's not going to change. I don't imagine the Bitcoin community will allow that to change. But
no,
but I think to me, the most interesting things that are happening in the blockchain space are in the other layer ones, which are the Ethereum, the Solana, the Avalanche, the Terra of the world. These are, by the way, these are all just, blockchain ecosystems. You can think of them as all decentralized databases where you can, run transactions and execute scripting logic, meaning like executing, a series of functions and contracts to make the make the app do something. So you can execute a series of functions and actions on these decentralized databases and computation system, which are called layer 1 blockchains. And that's how these, you can broadly speaking, how these are, what these blockchains are, right? And once these blockchains, Ethereum right now is still proof of work, but it's going to shift to proof of stake. And the other ones that I mentioned, they are already, Solana and Avalanche, for example, they're already proof of stake. So basically, these the participants that are participating in verifying the transaction activities on these blockchains, they're called the verifier nodes. They are, in order to be a verifier, you have to put up a certain amount of capital as a bond, basically, to prove that you have a stake in the economy, right? So if you so that you don't execute any malicious actions, or you don't cheat on other participants, and you actually honestly verify transactions. Because if you don't do that, your stake will be taken away. So it's essentially a chunk of capital that you put up, locked up in the system, to make sure that you are honest verifier, honest participant in the system. So this is essentially what the proof of stake is. And this stake allows you to, when you become a verifier, that allows you to earn a part of the revenue from the blockchain, right? So it's just blockchain takes a cut of the economic activities happening on chain as its income, and you take a share of that income as well, because you have provided this transaction verifying service, this computation power to this decentralized computer network. Now, there are different, but obviously, there are different types of staking. What I think for most people, you of course can, directly participate and become a verifier of a certain blockchain. But you can also become what is called a delegator. Basically, you delegate a chunk of your capital to a verifier, right? So it becomes part of the stake that the verifier put up and get locked up in the system. But in return, you also, gain a share of the proceeds from the income from the cut that the blockchain is taking of the economic activities happening on chain. So most of the retail investors or non-technical investors are going to be delegators. You basically, the so-called staking is you delegate part of your capital in the form of, you buy some ETH token or buy some Solana token, Sol token, and you lock it up through a particular verifier, right? And then you periodically receive proceeds as this so-called staking yields from this chunk of capital that you locked up. So this is broadly how it works. And there also that, because this is a very innovative system and very dynamic system, right? People are coming up with all sorts of ways to, get more yields out of the staking activity, or somehow make the staking activity more liquid. For example, nowadays there are so-called liquid staking. What it means is, now, like we just talked about, as a delegator to a blockchain verifier, you put up a chunk of capital and that's being locked up. So that's not liquid, though you receive, proceeds, yields or dividends from the stake that you put up, but it's not liquid. So the so-called liquid staking is to allow you to actually earn that yield, that staking yields, but at the same time maintain that liquidity, right? So because traditionally, if you stake part of your capital, there is a lockup period. Like for example, on Solana, it's usually, if you want to unstake from a particular verifier, it takes 2 or 3 days usually for you to unstake and take your money out. But with liquid staking these days, you can go in and out, in no time. But obviously, you pay a little bit to the service provider that's providing you the liquidity. So, so again, this is basically, from my point of view, this is the safest kind of yields that people can get from a blockchain system, because it's directly a derivative, it's directly a proceeds of the revenue that from the blockchain transactions.
Yeah, I mean, the potential opportunity in staking and yields is very, very attractive. And I know this sounds a little complex, and I started with 2 questions that would skew itself to being that way. I'm going to now segue a little bit on the DeFi side to probably more bigger picture macro and kind of bring them together. I said this probably a year ago, and very, very few family offices, although I starting to see a trend a little bit, is you're going to start to see CIOs and family offices hire digital asset experts internally. I mean, you heard about, Mr. Wonderful and what he's doing, very active in digital assets and buying teams and making them internal. The larger family offices have potential to do that. And that would be a way to get, ramp up your knowledge and exposure and opportunities. It could be very attractive in this ecosystem. But why don't we take a little bit of that step back and give that big picture? Will this be the biggest revolution in the history of financial markets, broadly DeFi, a challenge to banks, a challenge to the middleman, the people being active in this? Like, how will this all go down?
Yeah, so DeFi, a little bit, just going back to the what we just talked about. DeFi is the layer that is, in some cases, it's making use of these staking yields from layer one, right? So, but in terms of bigger picture, I think, I totally agree with you that this is, probably one of the biggest, or maybe even the biggest financial innovation that has happened in the past couple hundred years. And this is an innovation that is that is so big for a few reasons. And number one reason, if we compare the DeFi and traditional banking system, it's very, very expensive to run a bank. Now, first of all, it's very expensive to become a bank, right? That's a lot of hoops to jump through just to become a bank. But that's largely, on the regulation side. But just look at the business side. As traditionally as a bank, there is a lot of fixed costs and operating costs involved in the day-to-day of running a bank. I think the last statistics I read is it takes something like $600K a year to run a bank branch, and that is one single bank branch. So if you have, I think the average bank has like 20 to 50 branches. So that costs add up, right? And then you also have your database and security and compliances, back office, all sorts of costs. So it's very expensive to run a bank. But if you look at running a, lending borrowing service or quasi like banking kind of service on the blockchain, you can knock out a first version of your product with probably 50K. Deploy a smart contract and start offering lending borrowing service. The reason is because a huge chunk of the infrastructure cost is already carried by the blockchain that you build on. So the infrastructure cost of, verifying contract, the database, securing a contract, right? The account of, if it's a two-sided marketplace, on both sides of users, it's all being undertaken already by the layer one blockchain itself, which is the Ethereum and Solana of the world that we just talked about. So it took a huge chunk of your cost away, which allows, it just opens up so much space to innovate and to, build whatever new ideas on top of one another. So that's number one. It's because the economic, how the structure of entity is structured differently. It's just so much more, flexible and agile and cheap to run a DeFi app compared to a traditional bank. And secondly, this one is also huge is because it's the capital efficiency of DeFi. Because you look at, I think this is probably less of a problem in the developed, mature market like the United States. But you in a smaller market or in a market that's where the financial market is shallower, it's even more a problem, which is you have this high fixed cost of setting up a financial institution, which means, and also your market is limited by geography, more or less, right? So really the number of participants, the number of organizations or banks that you can have in this market is limited by the size of the market, given the huge fixed cost there is to set up a bank. So over time, what you see is banking is a very, very good natural monopoly industry. You have, the smaller the market is, the more obvious the problem is. It's dominated by, a few monopolistic players. And it has to be this way because there is a huge fixed cost. But then what the result of this is you have the incumbents don't have any motivation to innovate or provide better services. And also, you run on a limited market. It's bound to be the case that you have to keep a certain level of margin. Roughly speaking, the differentials between what you offer to borrowers and what you offer to lenders. You have to keep a certain level of margin in order to stay afloat. And the smaller the market is, the higher the margin needs to be. So that's why, in a lot of countries, the smaller markets, the financial, the availability of financial resources is very limited and it's very expensive to borrow money. So, but with DeFi, that completely changed the whole landscape because the DeFi market is global. You do not have any geographical limitations. You can take a depositor can save money in Ireland and you can lend the money to someone in Vietnam if there is a better return on capital in Vietnam. And all of that can happen, in a few minutes. So it really knocks down so much of the natural physical barriers of the traditionally financial sector operates. So that's number two, why DeFi is such a huge deal to the financial sector. And number three, which I think it's not talked about as much by people, especially by people in the traditional financial sector, is that if you look at the ownership model of DeFi and also the blockchain space as a whole, it's very participatory. It's like every bank in the DeFi space or every automated market maker in the DeFi space is owned by the community. So I'm a user of the DeFi product, but I also own the token of the DeFi protocol. So and through the token, I receive the part of the revenue of this DeFi protocol. So I'm both the owner and the user of the product. So now you may say, okay, you can use a bank and buy the stocks of the bank, right? But it's really, it takes that kind of relationship and ramp it up tenfold. It's because it's just a very, very easy to have access to the token of a DeFi platform. And because it's part of the, nowadays it's part of the incentive that's built in to encourage people to use the product and to provide liquidity to the DeFi protocols. So what you see is this kind of participatory ownership model. It makes the user base of the DeFi products very sticky because people are eating their own dog food. So yeah, so you're eating what you're using what you built, right? Or what you help to build. So so this makes it this makes the DeFi product, the financial product, takes on a kind of a viral nature that you would traditionally only see in, I don't know, Instagram influencers or social media space, right? So, but there is so I think that's very, very interesting, because that really helps to increase the reach and the stickiness of the DeFi products organically.
Yeah, I mean, I'm thinking from the perspective of most, let's go with the word investors, looking for a store of value, probably proof of work, 100% decentralized, at least we hope, with Bitcoin. But when you're looking at opportunities of how I could get exposure even to DeFi, with maybe not quite ready yet being for staking and yield farming, Ether of Ethereum or Sol of Solana, or the applicable token for Terra Luna, for Phantom. I mean, I could go on and on. So there are ways to get exposure to these protocols being built that are happening at like a breathtaking, neck-breaking pace. It really is amazing, without maybe some people being quite ready for staking yet. There's also opportunities in various funds and strategies where they could get some of these exposures as well.
So you mean, how is that the question, how people can participate in the DeFi
Right.
space?
And as one soft way, I'm simply, buying Ether and Ethereum, or buying Solana, or buying Terra Luna, or buying Phantom. I'm getting exposure to the underlying growth of those communities and what they're building and what's happening.
Yeah, so I mean, it really depends on, everybody's risk profile is different, and how much time you're willing to spend in investigating all these things, because there are different yields in DeFi. It goes into, we can talk about where those yields come from specifically. But
right. Well, it's not just the yields, it's the appreciation in the underlying token, and the ones that I mentioned, which has, in the case of Solana, since the beginning of the year, has been incredible.
So the way I look at it is, you got to think about whether you are whether you're the Warren Buffett, or the Casey Woods, or the Sequoia Capital of investment, right? And there are different things you can do. And the thing about the crypto space is you have a whole spectrum of risks and rewards that you can choose. So whatever appeals to you. Now, obviously, the very basic thing that most people coming from the more traditional finance background, or traditional investors, are buying Bitcoin and Ethereum. So if you buy Ethereum, you are basically betting on the Ethereum economy. Essentially, it gives you it's like a aggregate index of the whatever DeFi, NFT, or other use cases, that innovations that are happening on the Ethereum chain, because all of those things are going to, increase the adoption of Ethereum, right? So if you buy Ethereum, you are participating, you're making a bet on the ecosystem as a whole, without having to go into investigating, is this particular project sustainable, and how much is this going to moon, or is this going to zero? Most of the new projects probably going to zero, but it's not something that a lot of people have the time or energy to actually go investigate, right? So I would say the basic thing, obviously, is to bet on the layer ones like Ethereum. Now, Bitcoin is its own separate thing. So I do not consider it because it's not a smart contract ecosystem like Ethereum. Now, people are trying to build smart contract on Bitcoin. I think it's a full
probably through a layer two.
But you see, it's a chain that processes 4 to 5 transactions per second. Okay. Now, Ethereum is not so much better. Ethereum probably processes like 10 to 15 transactions per second. But there are all sorts of layer 2 solutions are being built on Ethereum. It's a very active, dynamic, fast-moving space. And the other layer ones like Solana, for example, it processes, I think right now, maybe like 5,000 transactions per second. So it's pretty obvious like which platforms are better suited for running decentralized computerization, computer scripts, right? Which is this so-called smart contracts. So so I would consider Bitcoin as a store of value as gold. I think it's going to it has already established itself in that in that brand. But Ethereum and Solana and the newer ones like Avalanche and Phantom and Terra, they are the proper smart contract platforms, and I think these are going to drive much of the blockchain innovations going forward. So if you don't want to go down the rabbit hole and investigate, oh, is this DeFi protocol going to make it or not, then I would just bet on the layer ones. So you look at layer ones, Ethereum obviously is the biggest one. Right now it has like over 75% of the total value locked in DeFi. So roughly speaking, 75% of the market.
Which is coming down.
It's coming down, but you look at, but it's a good thing, because say you have tremendous innovation in making the blockchain decentralized databases cheaper and faster. Innovations from other chains, innovations from side chains, from layer 2 solutions. Of course, all of these are going to take some attention away from Ethereum, right? But still you consider that the whole blockchain ecosystem is growing as a whole. So Ethereum is going to grow along with it, and it's the OG smart contract platform. It's so it's already in a pretty established position, and I don't think that can be easily toppled. So, but at the same time, these other layer 1 chains or some of the layer 2 or the side chains like Polygon, they are going to grow faster. And why are they going to grow faster? Because number one, they are literally much better user experience. It's cheaper and faster. Because, last time I made a transaction on Ethereum was something like I was trying to move some NFT from a browser wallet to a cold wallet. That took something like $100 worth of ETH just to move one NFT.
Gas fees, yeah.
So and I was pretty mad about it. And I was like, I'm not going to ever use this ever again. But of course, the next day I go back. Because still, it has an established ecosystem. It has all the developers' attentions and all the toolings in the space. The toolings include like things like Infera, like MetaMask, Hard Hat. These developer tools, the ecosystem make it, more developer friendly to actually build and deploy on Ethereum blockchain. But all of these are being very quickly built on other chains as well. And the other chains being smarter and cheaper are going to encourage a lot more innovation. So that's number one, because Ethereum is very, very congested, and that's not going to change anytime soon. That's opening up opportunities on other chains. So other chains are going to grow faster. And secondly, other chains are also using the same tactic that you used to see when the PayPal come out, right? PayPal was giving people money to actually use PayPal. So the newer chains are doing the same strategy, because everybody realized as a layer 1 chain, or as a basic infrastructure of the blockchain space, you need network effect. The more people who are using your chain, the more people will use it. So these newer blockchains are giving out huge incentives to people to build on their chain. And like, for example, what's the let me check quickly, what's the current staking yield. For example, on Avalanche, okay, the current verifier staking yield is close to 10%. So right now, this is not, so we talked about, you know, in the long term, the staking yields on layer one comes from the revenues from the layer one chains, right? You're taking cut of the blockchain economy. But it's not in the short term for these newer chains, and really the chains themselves are giving out incentives for people to actually participate in these chains. And that's some of these like very high yields, 10% on Avalanche. What is it? 13% on Polkadot. Solana 6.7% staking yields. So some of this is because the incentives, and some of this is because of the, you know, there is a token issuance schedule. You know, the chains are issuing more tokens to their stakeholders. By the way, some people think that's a bad thing. It's not a bad thing. You need a certain level of inflation as your network grows, because you want to have the token in the hands of as many people as possible.
I make the argument those are impressive interest rates compared to what people are used to. Do you believe in the comment, or at least it's worth to explore, reach for yield, reach for risk?
So again, you know, I think you can make some generalized statement. Okay, higher yield is correlated with higher risk for sure, right? So if you have if you do a econometric regression with 1,000 observations, risk yields, you probably see, you know, a positive relationship, but there are variations in this relationship, right? That's where the money is being made. So if you actually spend some time to look into, okay, how is this yield coming from? How much of it is you know, because you can generate, okay, you can get yields in DeFi or in these you know, staking arrangements in different ways, and you can get these yields from incentives of a new protocol, trying to encourage people to use it. So they give people like 1,000% APY, something like that, right? But you've got to look at what protocol this is, and is it already getting traction? If it's, I don't think for most people, the completely new ones, unless you have inside information about this particular product, that you know this is going to go somewhere. Otherwise, it's completely new product, give you 1,000% APY, it's probably, you know, I don't think it's worth most people's while.
Yeah,
but that's different from if a platform that is already getting traction and have real users and growing users, and you know that that APY it pays to you for holding the token is coming from a revenue source. Like, for example, you can stake your sushi token on SushiSwap. And where does that token yield come from? Come from the transaction fees for people making, making swaps on sushi, or using other products of sushi. So that's you're basically, it's a stock dividend, very similar to that.
Yeah,
right?
That's an interesting way to look at it. Yeah, I mean, for some of the platforms that you noted, Ethereum, Terra Luna, you might have mentioned Phantom, I'll mention EOS. It's looking at it from a family office or investor perspective that may not quite be ready for some of the more complexities of staking and of yield farming. Investing in a diverse basket of, let's use the word tokens, cryptos, relative of those gives you exposure. Who knows who the winner is going to be? Ethereum looks to be pretty well positioned, but Solana came from nowhere and is a very dominant kind of number two, if I could use that word, player in the market. So those that are looking at it over 5 or 10 years, shouldn't they have a diversity of holdings in the community?
So if you look at, I'm just looking at on my phone, in like CoinGecko, the top 10 market cap crypto tokens, it looks like 6, 7 of the top 10 are the layer 1 chains now, but it wasn't the case a year ago. Okay, so if you go to use like Internet Archive to look at CoinGecko or CoinMarketCap to see what's the top 10 token a year or 2 years ago, it's not this. It's not this. Okay, so these alternative layer 1s has really, come a long way, and I think this speaks to how much the real life use cases that blockchain economy has gained over the past couple of years. Because I remember my first encounter was the whole crypto blockchain space was in 2016, 2017. I was very involved in the startup community, and I have some startup friends who were, pitching these business ideas with blockchains. And at that time, the running joke was you pitch something to venture capitalists, you need to have the keyword blockchain, crypto, and AI in your pitch. That's how you get money, right? But at the time I look at, well, this is, yeah, sure, crypto, okay, decentralized blockchain. But it looked like a solution that was looking for a problem at that time. So I think that was, but my impression started to change starting with DeFi. And then that made me really go down the rabbit hole, because I realized, oh, the space has really found, at least right now, the first like real groundbreaking use case that's actually going to ripple through the real life in a very revolutionary way.
Oh, for sure. And I mean, I know we're giving people who are, many of you, relatively, again, just getting over buying Bitcoin and Ethereum, and this is a lot coming at you. This is one of the reasons why, to really go from 0 to 100, you probably do need to see the value in this and probably do a masterclass. I mean, I run them and others do as well. Could you learn it on your own? Could you learn it through YouTube videos? Well, actually, yeah, part of it you could, but is it going to be more effective and efficient depending on who you are? To get a little bit more hand-holding on some of this, at least I would think so. Now, I'm looking at the clock, although we do have over potentially an hour left. I literally may have 200 questions. Maybe I knock that down to about 20 more, but maybe we could go a little bit lightning round, if I could use that verbiage. So I mentioned before that DeFi is really changing the world of banking. It might even be a massive and will be a massive threat. Now, when I couple central bank digital currencies to that, how do you see a future for banks and many financial intermediaries looking 5 or 10 years out? I'm having a hard time finding it in traditional finance.
Well, I think it's actually going to be a more nuanced, because what the traditional banking have that the DeFi is trying to get is liquidity. Is people is actually putting up capital and participating in the system, and all those DeFi protocols, issuing tokens to their new participants as rewards and incentive, because they want to win liquidity. And it's a very tough game because the entry barrier of DeFi is so low, right? So the code base of Uniswap was forked like at least 2-3 times. To build new products like Sushi and QuickSwap on other, either on other chains or, with some other modifications. So it's a very low entry barrier space, which makes the industry as a whole very dynamic and innovation very fast. So that's a good thing for industry as a whole, and for end users, it's probably a blessing, right? But for people who are actually creating and running the projects, it's a headache, because your moat is very hard to defend. So unlike in traditional banking, you get a banking license, you set a bank. Yeah, that was a very, very tough, but once you're in, you're good, right? So so traditional banking, I think I would draw an analogy with the internet era. You see, the internet comes on, the internet get adopted by the mass. And that was a huge disruption to traditional media, right? The traditional newspapers and magazines, and a lot of them died. But a lot of them are still around today, but they couldn't be still where they were before, right? So they had to innovate. The New York Times and the Washington Post today, it's their economic model is very different compared to 20 years ago, right? Because but they had the financial capital, they had the human capital to actually keep innovating and keep up with the time. And still, they have a hard time to keep up. But still, but they are around, right? They haven't died. So I think you may see, yeah, some of them, but you may see, but still their share is shrinking, right? But you still, we are what internet started in 1980s. We are 40 years in now, but traditional media has not died totally, right? So I think the same. Well, they have reformed. They have transformed. If they were able to transform,
a lot have disappeared, but that's going back 40 years to now. What's happening and what we're talking about is exponentially happening.
Sure.
Even like multiple times faster.
Sure, but the same. I think the same idea still applies. You will have different players that have different challenges. So what I see is for traditional banks, the smaller ones, the regional banks, the credit unions of the world are going to have a hard time because they will not be able to compete with the DeFi, with the Terra. Give you like I think the Terra gives you close to 20% APY on your stable coins. How are you going to compete with that? But the larger banks, if they want to compete, they could. They could have their own DeFi protocols. They could have their own blockchains. It could be centralized.
Well, I mean, JP Morgan tried their own coin a couple of years ago.
I would be surprised if they're not actively, trying to see like how
they're working on it.
Yeah, I'm sure.
I don't know if it's going to work out too well, but they're trying.
They're working on it. But the thing is, they have the liquidity from the customers, they have the capital, and they have the human resources, which the second, third tier banks don't have. So I think the larger guys, if they play their cards right, they will be able to survive. But I think the banking sector share as the share of total financial services is going to go down.
Oh.
And the existing banks, they're going to have to find ways to integrate with the blockchain economy, because that's where the liquidities are going to be in the coming years. If they have their own blockchain system, it's going to have to be interoperable with the public blockchains like Ethereum and Solana of the world.
I mean, that's the big picture I'm just trying to get through to a lot of investors. Everything is changing. It's changing fast. Literally since COVID, about 18 months, it's been shocking what has evolved so far. And it's not just how can I make money in it? And I think there's a lot of money to be made. It's you're going to lose function in society. We're going to have wallets, central bank digital currencies. All of this is evolving very quickly. And if you're going to have your head in the sand and not wake up to it, it's going to be harder for you to even function. I mean, we're talking about banks as an intermediary, credit cards, even insurance. I mean, there's a variety of things that are going to look very, very different. The incumbents will look for political influence and regulation, and they'll win some battles here or there. Many of them, I don't know, Goldman, JP Morgan, they'll figure it out and they'll adapt. But in the long run, you can't stop the progress of what's going on. It's so intriguing to me and a little scary, but it's an intriguing time. Let me ask you a question from this perspective. My numbers are probably a little off, but let's go with that. They're right. The global stock market cap is probably about 120 trillion. Global real estate about 350 trillion. We're only at 2.5 trillion, give or take a little bit, in crypto digital assets. Within 10 years, do you think that number will be 50, 100x, maybe more?
Yeah, I mean, if you extrapolate the past year's, growth rate, which is about 200 to 250% a year for the crypto space as a whole, right? If you extrapolate that number forward, that is going to get you to at par with the traditional with the market cap of the traditional financial market much sooner than 10 years. Now, obviously, you can say, okay, well, maybe going forward, let's just be conservative. The growth rate will not be so fast, but I think you do like even if the space grows like 100% a year, which I think is pretty conservative. To be honest, you can do the math. It catches up quickly, right? So right now, you see this year, the crypto in like a regulatory space is making so much noise. It's because the sector is just on the verge at being systemically important. So that's why it's starting to catch so much regulatory attention, and all the central banks are scrambling to think about what they need to do. And so that's why you see the interest in CBDC, the central bank digital currency, like picked up a whole lot since COVID. And because I think many of the central banks start to realize, oh, this is going to, if we don't do something, this is going to dramatically reduce our ability in conducting monetary policy and supervising the financial system.
Which they do a lousy job at anyway. So bringing in still centralized, they could still print, although not literally print, but you get it. It just gives them more control over the people. I've covered central bank digital currencies with people in China and around the world. Usually it gets to be a little interesting, our conversations, but I do agree there's nothing that will stop it from coming, including here in the US. And in some ways that's a little scary. But isn't the big picture, like if you're sitting on the sidelines strictly as an investor and you think this progress is not going to happen, and we're talking about maybe over 10 years, 50, 100 or more X, no guarantees. I have no idea. Maybe it goes to nothing. I really don't think so, but I can't say for sure no. Like you're missing out on such a tremendous opportunity. I feel like you have to get involved directly through an LP, whatever it may be.
So an analogy that I talked about this before is if you look at the beginning of Industrial Revolution, right? Actually, not like strictly at the beginning, but let's say when the Industrial Revolution starts to take off at the late 19th century and early 20th century, it actually caused a dramatic drop in wealth inequality in the old world. In Britain. And one of the reasons is because the traditionally the rich people in the British society, they were the landed gentry. They were the aristocrats that owned farmland in the countryside, right? So, but at the end of the 19th century, you had a new world, the American market opens up, it starts to export agricultural products that flooded the world market and reduced the price. And on the other hand, you have this new class of industrial capital, the productivity of which started to dramatically increase. So you have these confluence of factors that led to, at the end of the 19th century, beginning of 20th century, the rich class in the old society basically collapsed. Because the holdings of wealth of the traditionally wealthy class was mostly in, as we mentioned, in agricultural land, and that dramatically depreciated very fast. And the industrial capital in factories and machines. So you see the, Henry Ford of the world, which is the new riches of the 20th century, rose very quickly because that's the new form of the embodiment of capital that was fastly appreciating in that time of change where a societal shift in the economic structure and in technology was happening very fast, right? So that caused the collapse of the rich class in traditional society. And we may see a similar thing today because we have the demographics of people who are investors in the crypto space, which I think is going to be the embodiment of capital of asset of this century. Okay, that's quickly appreciating. And you have the more traditional investors who are the existing rich in the society. They're underweighting the crypto, asset class as a whole. I'm not talking, of course, there are always people who make money in all weathers and all time, right? But I'm talking about on average, the older and more traditional, like a well-to-do class of the society is underweighting crypto in their portfolio. So you may see we may be going through one of those time again of a drastically changing, wealth distribution in society.
I think that's extraordinary what you brought up. To say that I agree with you 100% would be understating it. And I've spoken about this, and usually it ends up getting me in trouble. Not only will there be countless millionaires and billionaires being created, I'm not so sure there won't even be trillionaires. Now, again, it's all relative to the value of money and at what time. You're 100% correct. The more traditional has been slow to adapt. They have other people running their money. They believe in the philosophy of don't lose money, rule number 2, don't forget rule number 1. And that sounds great, but then you look at inflation and the purchasing power. And I know from Jack Dorsey's tweet and others that people are gravely concerned about our supply chains, about our debt, and about runaway inflation, possibly, God forbid, turning into hyperinflation. What I'm basically trying to say is if you're worth 10 or 20 million, maybe in 2 or 3 years, it's not going to feel like that. If you're worth 200 million, it may feel like 10 million. Now, am I embellishing things a little bit? Okay, probably to make a point. The big picture that I'm getting at for those that are on the fence or on the other side is probably, no guarantees, over a 5 or 10 year period, you better be active in crypto and digital. You're going to need exponential style returns to be able to keep up with inflation and hyperinflation. It's my opinion. You just said it more eloquently than me, so thank you.
Well, I'm not sure about inflation. I actually don't think the inflation in the long term is going up, but it doesn't, the big picture stays the same.
No matter what side of the fence we're on there, for sure. Let's go back a little bit, and I guess it's going into the weeds, but yield farming is the practice of staking or lending crypto assets in order to generate higher returns or rewards in the form of additional cryptocurrencies. Although we've mentioned yield farming, but I don't think we took a step back and have given, per your perspective, a definition.
So I think it's a term that it has been blurred much because there are so many ways. There are different ways of how to get yields. Basically, yield farming means you put money in to get yields from crypto, and usually it's a much higher yields than you could get from the banking system, right? And from yes. On the flip side, so that's from the user side, the yield farming. On the flip side, from the product creators in crypto, this is what's called liquidity mining, and it's the same thing because if you are earning yields, I'm the product creator, I'm giving you the yields. Why am I giving you the yields? Because I want your liquidity. It's the saying that we talked about earlier, the moat in DeFi is much harder to hold compared to traditional banking, right? So the thing is you can deploy your code very cheaply, no problem, but you still need participants. You need people to actually put in money, right? Whether it's a lending, borrowing product, or it's a automatic market makers, you need people with coming in with money to participate. So a lot of these protocols are giving people their the protocol's native tokens as a form of reward for participating in these in all range of activities that you can carry out on DeFi app. You can get native protocol tokens by depositing, by borrowing, by trading, by providing in the liquidity pools. So that is one form of yields, which is you get in the form of the native token of the DeFi platform that you are in. Okay, so that is a way for DeFi protocols to attract liquidity. Now, obviously, the thing is that kind of activity cannot go on forever, right? And it's quite expensive for DeFi protocols. Okay, if so, Uniswap give you like 1% for whatever swapping activities you do. Sushi Swap, will be incentivized to give you 2%. To attract your liquidity to use Sushi Swap, right? So this is a game of chicken. So it's not good for the DeFi tokens, for the DeFi protocols themselves. So people are coming up with some various ways to actually solve that problem. But on the user end, it's all the better for the user, because many people just hop around the different DeFi protocols to look for the highest yield, to essentially the incentives that the platforms give out for people to actually use their product. So that's a long way to describe actually just one type of yield. Is the incentive, is the incentive that a platform or a protocol gives out users for using the product. There are other types of yields. The simplest one is what we already talked about. You stake a token. Like, for example, if you stake a Aave is a lending borrowing protocol in DeFi. You stake an Aave token, and you get something in return. Why do you get something in return? Because you are providing essentially a deposit insurance. Because if there is a liquidation event, and if there's some kind of black swan event, and the protocol, if Aave have to return the money, if its asset side collapsed, and it has to return the money to its liability, to cover its liabilities, you will be contributing to that. So because you're providing the deposit insurance. So you get a return for providing the liquidity to the protocol, and you can do that on platforms like Aave or Sushi Swap, where you get a combination of incentives and liquidity service rewards, and then also the returns. Part of the transaction fees that Sushi collect returns to its token holders. That's similar as a stock dividend. So it's a combination of incentives for attracting users to use the platform, compensation for providing providing liquidity or security to the platform, and stock dividends. So it's it's different platforms. Maybe their yields are coming from a composition of these different things. And also The other type that is very popular is the LP staking, the liquidity pool on a automatic market maker like Uniswap. So how Uniswap, so traditionally, if you go on a, if you go on a stock exchange, right, or the traditional like exchanges, the way people, the broker matches the sellers and buyers is usually through the order book, right? So I want to sell 500 shares of Apple stock at minimum $1. You want to buy it at the max $1 for 50 shares. So then we can strike a deal. We have different entries in the order book, and the brokers match the two. So in the crypto space, this is the automatic market makers do it differently, so that they can get the thing kickstarted with less of without too many entries in the order book. Because initially people don't have that order book built, right? So what people do is you set up 2 liquidity pools. So if you want to exchange, Sushi token and the Uniswap token, right? So you have a liquidity pool with 100 Sushi token and 100 Uniswap token. And when you participate in these liquidity pools, you basically provide your token to these two. And then people who want to swap between the two, now they have something available to swap. And the exchange rate between the two is decided, is calculated by the balance of the 2 pools. So that's the automatic market maker in crypto. That is a different, it's also an innovation different from the traditional exchanges. So to participate, if you participate in these liquidity pools, you take a cut of the transaction whenever someone wants to swap Sushi token to Uniswap token or Uniswap token to Sushi token. So you take part of that trading fee. So so that's another kind of yield you can get in DeFi in providing that liquidity pool service. You can get yields by outright lending your liquidity to people who are traders, who want to take on leverages to play around the volatilities of the market. Some of these are long term, some of these are short term, but essentially I think some of the yields that you see in some of the CeFi platforms like BlockFi or what is the other one, Celsius, things like that. They usually that's how they generate the fee. At least that's one of the ways they generate the yields. Is you deposit liquidity and then they lend it to traders, usually higher frequency traders, and then that yield is generated in that way.
Yeah, I mean, I'm assuming even some of our people aren't even familiar with that. So you could own Bitcoin, Ethereum, and other significant layer ones, and not just to participate in the appreciation of that, but you could lend it out. Bitcoin now probably ballpark 3.75 to maybe 4%. Again, compared to traditional finance, that's great. But there is a but coming up. I suppose there could be counterparty risk. What did I say earlier? Reach for yield, reach for risk. There's other things that are far more aggressive.
Yeah. So I'm none of the things that I just said had I haven't commented anything on the risk involved, right? So obviously, all of this involve risks. And if you participate in the liquidity pools, that there is a huge risk, what people call impermanent loss, though I don't think.
Yes, I was going to bring that up.
You have these 2 pools, okay? You have one, you provide 100 Sushi token, 100 Uniswap token, right? And if the Uniswap token price goes up, now people who are on the other side, who use this liquidity pool, they are going to, sell the Uniswap token and get more sushi tokens. So what you end up with is, it's what you end up with in your bag is an imbalanced pool. You have now less Uniswap token and more sushi token, and you're actually worse off compared to at the beginning when you just holding 100 of each, right? Because now you have less of the token that has appreciated and more of the token that has depreciated. So, so that's the thing is like some people, they call this type of yield farming, it's a young person's sport because you have to watch it. You have to monitor and see what's going on. And, all these different pools, their yields may change, and how these yields are generated, they may change, right? So your strategies need to change. And you are always on the lookout for the next pool or next protocol that gives you a higher yield. So that is a more than a full-time job.
Oh yeah.
So, but you could do that, and people have done that very profitably, just to experiment and exploring different strategies in these different DeFi protocols. But now, now actually, since this space is constantly innovating, right? So people realize this is a problem, right? People don't like impermanent losses in liquidity pools.
I would think not.
And also people don't like you have to click on so many buttons because you need to have the Uni token and the sushi token ready in equal proportion before you put in a pool, right? So you have to do a lot of maneuvering, and that's quite a hassle for people. So now there are also protocols built on top of these liquidity pools and staking solutions. You basically give you deposit one token, be it ETH or be a stable coin or whatnot. And the protocol does all of that on the back end. You don't have to, put in the balance your pools and watch your pools. Then you just put in one token and you give it to those guys. Essentially, they manage your money in these liquidity pools and looking for yields. And what you get is a yield, just one number of yield. If you want to, that simplifies things for many people. So you can also look into that if you want to simplify your life and put in less time. And also you put in the token, you get a yield back. On the back end, the platform may use your token as collateral to borrow and to trade, so as to generate a yield for you. So you implicitly take on some leverage, but that's differ across depending on different protocols. But these things are getting more and more sophisticated as we speak.
Yes.
But I would say I would definitely go back to what we talked about at the beginning. What would be a strategy for our audience who probably don't have all day to play around in DeFi? I think you could, but the thing is, if you want to at least invest in the DeFi protocols, you at least spend some time to try to use the product. That's number one. What I always tell people is, you don't want to buy something that you haven't tried the product.
For sure.
It's the same thing if you invest in a consumer facing company's stock. You probably want to use the product first, right? So you put up a little bit of money and try these protocols and see how they work and see what your user experience, and if you like it or not. And if you don't like it, I don't see why you will hold that token for long, at least, because a lot of these, if your strategy is to buy a DeFi token or buy a basket of DeFi tokens and just hold it because you expect the space as a whole will appreciate over time, you probably hold it for like more than a week, right? So
I would hope so.
So that means that you need some level of conviction. And where does that conviction come from? Part of it comes from you actually know something about the product, and that comes from actually get your hands dirty a little bit, at least, to use the product yourself, right? So if you want to buy a sushi token, you go try sushi's product and see if you like it or not. And even if you are not technical and you cannot examine their code, or you can still learn a lot in many cases by look at how your user experience is just on the front end, right? Because like people say, the way you do one thing is the way you do everything. So if you have a good experience on the front end, well, let me say the opposite. If you don't have a good experience on the front end, to me, like I totally do not have confidence that the team will actually, execute soundly on the back end. It's a different level of it requires a different expertise for sure. But it tells you how the team approaches the things and what's the level of thoughtfulness that put into their product, right? So that actually tells you a lot about how the team works. And obviously you can participate in their Discord channel, and you can talk to people, and you can follow the founders on Twitter and see what they're up to. And but I would say the same due diligence that you would do as you invest in a traditional company stock. You try to use the product, you try to see who's behind it, right? Even if you don't participate a lot in the yield farming and so on and so forth. And different people have different strategies. You can, there are people who just, I'm going to equal weight top 10 DeFi tokens as a percentage of my portfolio. Mm-hmm. You can do that. Me personally, I don't do that because I don't mind actually spending time to go down the rabbit hole to actually look at specific protocols. And also, I'm a bit more comfortable with concentration than some other people. So I pick the things that I actually feel confident about. But I think there are so many opportunities in this space,
There is, and I agree with you. And I tell this to people that I work one-on-one. If I learned it, you could learn it. Learn how to use MetaMask safely. Learn how to use Uniswap from a MetaMask. Learn how to use MetaMask to go on OpenSeas and create an NFT. That's going to make you more engaged in the process. You're going to gain confidence in your capability, which is probably way more than you think it is. And these are the things that one-on-one work for some of you could be very, very valuable. There's one family office that reached out to me, and I kind of hinted earlier, where at their institutional level, although learning how to do some of these things hands-on are great, I basically recommended they should bring on board under the CIO a digital crypto assets professional, someone it's an employee, for lack of a better word, 24/7 dedication. And, me helping to source from my network was able to, let's just say, to make that happen. I will make a disclaimer while we happen to be in the midst of a very intense conversation. One, this is for entertainment and educational purposes. Everyone's situation is different. When you invest, what could happen? You could lose all your money. So you need to be very careful. Again, it's for entertainment and educational purposes only. Everyone's situation is different. You absolutely need to do your own diligence. A question, kind of a big picture question. DeFi is the money Lego, if you liked Legos like I did growing up. DeFi is the money Lego of crypto finance. Does that mean anything to you?
Well, I think we've spent a lot of time talking about these money Legos, right? So
That's just
these
a different way of phrasing it. Yes, they
yeah,
all
these are products that build on top of each other, and the
exactly.
different ways to get you yields, and different ways to repackage cash flows. Different ways to use collaterals. I think we've seen a lot of innovation in all of those things. What we have not seen, and I think this is and there's a reason why, that we have not seen a lot of integration with between DeFi and the real world assets. What I mean is, I think this is actually, if we can solve this problem, it's going to really supercharge the growth of this sector. Is right now you can use collateral to borrow, but you can only use cryptos as collaterals, right? So,
Yes.
but most of the collaterals in the world, they are not crypto assets. Most of the collaterals in the world are in real estate and in securities, and that kind of thing, or the business receivables. And I think all of those are going to be bit by bit, integrated into the crypto space, and that is going to open a floodgate for DeFi to further develop. Right now, the innovation that you mostly see are the kind of innovation that you can execute by sitting in your basement on a computer coding. Right, so you can repackage different lending products. You can, mess with how the cash flow is sliced and diced to provide different trenches of, yields with different risk levels, that kind of thing. You don't need to leave your house to do any of that. It's all happening, in the digital space. What is harder is to bring in the collaterals that is not in the digital space. Now, I think that is going to be happening gradually, at least, in the space that in the collateral, in the cash flow as collateral. I think that's actually not that far away, because once you have businesses that and individuals and starting to take payments and salaries on chain, that immediately that cash flow can be incorporated into DeFi and turned into collaterals for borrowing and lending. What is harder is the brick and mortar collaterals, which is the huge chunk in the collaterals that we use in the real world. That part of the development is happening very slowly, because that kind of innovation you cannot just do sitting in your basement. But it's surely happening, and I think that would be the next challenge for the DeFi space to get another quantum leap, so to speak, because the kind of money Lego type of innovation, we are not going to run out of those. Those are happening very fast and very easily, but the thing is, that kind of product also very hard to defend its mode. And I see a question, someone's comment in chat that the community is the mode. Yeah, in some sense, yeah, community is the mode, but you do realize community can be bribed too. If JP Morgan starts a DeFi product tomorrow, if they decide to do so, and they decide you use a JP Morgan swap, every time you use it, $5 or $100 get deposited into your JP Morgan wallet, why would you not do it? So that's essentially, as we talked about, a lot of the DeFi products are actually using that strategy is to give people incentives in the form of their native tokens, but then everybody's trying to outdo each other, right? So that issue is people are coming up with solutions to that, but I think that in itself, it tells you the competitiveness of the space.
Yes, it looks like one of our Anon participants probably knows a thing or two about the community. I see a comment, most DeFi is over collateralized. Until they change the mainstream, not going to adopt. And I think from what you just said, he commented, he or she, whoever, this was attempted with vampire mining. People didn't abandon Uni. Now we're getting a little deep in the weeds here, but I don't know if you wanted to comment, that we can move on to the next question.
Yeah, I think that, things are not black and white, right? So there are protocols that just fork some other protocol's code and run with it and became very successable. And there are protocols that try to do that and it didn't succeed. We see both cases, but again, the mode in this space is much harder to defend than in traditional finance.
Now, talking about where it could even go to the next level and capital pouring in, that has not really happened yet. It's going to be the institutions. I'm assuming they're looking for clarity on regulation, on guardrails, but this is coming. I don't know, 3 months, 6 months, a year, maybe 18 months. And we all know they're a little slow to adapt. They take forever to make a decision, but eventually they're going to come into the space. The good, the bad, what is it going to do to it?
So, I think the institutionals coming into the space is, like you said, inevitable, right? Because that's where everybody nowadays sees everybody's seeking yields and everybody's seeking higher returns, and this is where the returns are. And that is a reflexive cycle in of itself. The more people expect the space to go up, the more eyeballs and users and investors you accumulate. At some point, this cycle reverses itself, right? Everything crashes down. And on the downside, there is a reflexive cycle too. But the thing is, the crypto space is a black hole that's attracting so much capital. And so much capital is actually being used to innovate and produce new products that is going to come out with a time lag, and that will support the next leg of crypto adoption. So to me, I think that the train has long left the station. Whether we are going to have a boom cycle, or how long the boom cycle is going to last, when are we going to reach the top, and how long are we going to have a bear market? Regardless, this space is going to continue and develop with tremendous momentum.
Yeah, no, I would agree. I mean, you mentioned it. I'll bring it up a little more directly. Yeah, I'm looking at it very favorably. Like I said, very favorably over a block of even upwards of 10 years. Is it going to be volatile? Of course. Are there going to be some things that are scary? Are there going to be bear markets? All those things. We're probably sometime next year, I could argue, due for a crypto winter. So there may be various ways to hedge or to mitigate that. Maybe it'll be different this time. But again, if you're looking at it somewhat more longer term, you understand this is still pretty nascent, and that opportunity.
So I totally agree, and I think that's why we talk about you got to develop some level of conviction, and when does that conviction come in handy? That's when the crypto winter comes, right? So because I think whoever said like people overestimate the short term and underestimate the long term.
Yeah, it's a great.
We are looking at, if you're investing in the internet space, we are looking at the 1990s right now, right? So it's if I were to draw the analogy, there may be a crash, like we see, and we have seen a few crashes like that.
Kind of like clockwork.
But those crashes, they come. But still, you see, like if we are in the 1990s in internet, the bulk of the actual realization of the capital gains that happened in the late 2000s and in the 2010s, right? So it's like 15 years down the road, and extending to today. And that wave of internet revolution is far from done yet, right? So so you're looking at if you're going to invest in the space, I wouldn't look at this as a way to to capture some kind of short-term gains. Of course, that there is a lot of opportunity to do that too, because the volatility is huge in the space. But to me, it's like as a investor, I'm not a trader. So to me, I would rather I pick the things that I think is going to have long-term potential, that has a big enough vision and big enough room to run for 10, 20 years to come. And I would, whatever, like winter, summer of crypto seasons, I would never reduce my position to zero. I will always have some skin in the game. So but again, like you said, this is different to everybody's situation, right? Mm-hmm. You may, if you don't want to do research, you may just do a index style, equal weight on the top tokens or something like that, buy an index. But I think there are opportunities that, to me, they are going to run like in the Amazon style, and we are seeing the 1990s of Amazon.
A couple of quick questions. Polkadot has unique functionalities. If you could talk a little bit about, from your research on Moonbeam and how it's positioned itself, I think pretty intriguing.
To be honest, I have not done much research on the Polkadot ecosystem. The reason is I'm only interested when I see adoption, when I see signs of adoption. When
it's a kick in the pants to Polkadot.
That's why, I look at the top 10, right? That's why I'm not going to equal weight the top 10 token, because I look at some of these, okay, Cardano, XRP, Polkadot, I'm not interested, at least not right now.
How about Cosmos?
Cosmos is different story, but like I will come back to this a second. But like, to me, I will be interested when I see some initial adoption in the form of, I see developers start building in this space and they're actually pushing out products that I want to use. Like all the chains I invested in, like Solana, for example, I used a lot and I like using it. And I invested it because I like using it. And I see a lot of new product. I see this protocol are really getting traction, and real world traction, not just like people talking on YouTube kind of traction. So I don't, this has nothing to do with the technology validity, how good the tech is, how good the team is. I'm sure Cardano has great team and great tech, but I just need to see traction.
No, that's fair. Okay, since you brought up, and I know it's been the darling this year, Solana, I'll ask you a very direct question. If you don't want to answer it, don't answer it. Do you think, yes or no, within 10 years, so we're going to give it 10 years, will Solana 100x what it is now?
So let's see, Solana right now market cap is like 60 billion. Okay. 100x, so 600 billion. Yeah. My answer would be yes.
My
Yeah.
answer is the same, which means
I think it
if
would
we
be
all feel that way, we're probably wrong.
but you know there are all sorts of of course this is my personal opinion.
There's
okay?
lots that could happen.
And then people are saying, okay, Solana is not fast enough, okay, and Solana is not decentralized enough. To me, it is. To me, it is decentralized enough at current stage of development. And Solana is not making money, sure. I mean, Amazon was not making money the first 10 years. And Solana cannot scale. Well, if Ethereum has roll-ups and layer 2, Solana can have too. And it's a better layer 1. It's a more efficient layer 1 to run layer 2 on. Okay. And about decentralization, I think people have this misconception about like decentralization as if it's a killer application of a blockchain. It's not. It is for something like blockchain, because the killer app of blockchain is sovereign money, is the private money, right? So it's a non-government controlled money. Solana is not non-government. It's not trying to be non-government controlled money. It's a smart contract platform. Okay, you have a certain degree of decentralization. To me, that is a mechanism mostly to achieve democratic participation, to achieve a larger scale of of adoption. That's an additional benefit of a proof of stake system compared to proof of work, to me. But it does not require the same level of decentralization as blockchain.
I completely agree.
Yeah, so I think people who are emphasizing on that is missing the point. You have to look at what is really important for this particular use case for this particular platform. And in this case, what we really need is the thing needs to be cheap, it needs to be fast, it needs to allow people to experiment and innovate on with relatively low cost, so we can see as much innovation as possible in the shortest time span as possible.
On the subject of decentralization, and a question came in, I was going to bring it up, but based on the Nakamoto coefficient, Solana, a little hard to believe, but Solana is the most decentralized by far of the layer ones.
I haven't checked that. Well, good to know. I don't know.
Getting a little deep there for the audience on the Nakamoto coefficient. Do you have a take on the Olympus DAO?
Yeah, I actually find it really fascinating. I think they are, if they, of course, it's very far away from being a money. Okay, very, very far away from being a actual unit of account and medium of exchange that is getting adoption, very far away from that. But if we are going to have something like that in the crypto space, aside from the stable coins that we see it now, this, Tether and USDC of the world, I think it's going to, I think that's the Olympus DAO is taking the right approach of doing that compared to Bitcoin. I don't think Bitcoin will ever become a unit of account of anything. Period. You just, to be a unit of account and a transaction medium, you need to minimize the uncertainty on both sides of transaction, minimize the transaction cost on both sides of the transaction, which means your value needs to be pretty constant with respect to a basket of real world goods and services. And this is absolutely not true for Bitcoin. And you are not going to see, Angelo, if I asked you, well, you can borrow $100 from me today at 3% interest rate, and pay it back over the next 20 years, but you have to pay it. Everything will be denominated in Bitcoin. Would you do it? No, because you expect the thing is going to appreciate massively. So why would people ever enter into that kind of contract, right? So if you actually use Bitcoin as money, as a unit of account today, you're going to see a huge, a huge shrinkage of the credit lending, borrowing lending, deposit lending market. And that's not even taking into account just the day-to-day, denominating the goods and services. Even that, it will not work because you don't have a stable value. If I sell you an app, if I sell you a Apple or if I sell you I don't know, my keyboard today for $100, and that as a seller, that price is going to, I don't want to change that price every day. And because a lot of things, my financial calculation depends on that price being stable. But if it's denominated in Bitcoin, it's very hard to have that expectation. So if the crypto space is going to have a unit of account and transaction medium, it needs to be stable in the sense that you can reasonably expect that 100 token of this, whatever token it is going to buy me a week of grocery today. And it's also going to buy me a week of grocery a year from now, 2 years from now. So it needs to, its value in terms of the actual value it denominates needs to be stable. So I think in that sense, Olympus style is taking the more reasonable approach, which is they are like a central bank does. You have a basket of assets, in this case, the crypto assets, and then you issue this token, right, backed by this basket of asset, and they are trying to accumulate this, make this basket as big as possible. And so, and it's the same thing as this DAO does, as what you see a central bank doing open market operation, is you buy and sell your currency, your token, in the market, backed by these, because you have these pool of assets backing you, right? You buy and sell your token in the market to make sure the value of the token is relatively stable. So it's the same thing as how the central banks stabilize the value to minimize the exchange rate volatility of their currency.
For sure. That was an excellent definition. It's really been a pleasure. We still have a couple of minutes left, but I want to make a comment. Hopefully for those on the sophisticated investing and family office side, I mean, you're realizing this is much more than just Bitcoin or even Bitcoin and Ethereum. And it does get a little complex. We didn't even get into the metaverse and NFTs. We may touch upon a brief comment and have Tasha back in the future on NFTs. And this is where, I mean, I'm just being direct and honest. As an organization dedicated to that community, with my experiences and knowledge, my connectivity, we could absolutely be a help to you. I've never had something like this before, where probably dozens of executives in the family office are like, Angelo, I want to learn more. And I'm like, do you want to, is it for the benefit of the principal? Well, yeah, but he or she may not be ready for that yet. I want to know more as simply someone who's an investor. And I think you could take me from 0 to 100 quicker. So the opportunity of, never had that happen before on anything else to the level that I'm having it have on crypto and digital assets. So, we could definitely be a resource to those that are members of Family Office Association. Simply use me, call me, email me. I'm happy to help where I could. Since I guess I'm the one who brought it up, and I know it was in the title, we're just not going to have a chance to cover it, but I want to just give it the lightest. Those of you that are, I'm telling you, you're all underestimating NFTs. It is way, way bigger than digital art. And by the way, there's nothing wrong with digital art. That's going to be huge. This is, you won't be able to function in society in the next 5 or 10 years if you don't understand NFTs, how it integrates with blockchain and the crypto community. Gary Vee is opening up restaurant membership clubs where you must have the NFT. Look at opportunities, not just in art, but in music. Look at eventually stock certificates, driver's license, medical records, tokenization of real estate and assets, of collectibles. This is going to be huge. You have a chance to wrap your arms a little bit around it now and maybe be active in the NFT community. What you felt you missed out on 12 or 13 years ago in Bitcoin, you have an opportunity now to be up to snuff relative to NFTs. I'm going to do hours and hours about this. Why don't I stop and I give the final 2 minutes to you before we learn more about how people could follow you on Twitter. And I know you have to run strictly at 4 p.m. Eastern. What would be concise, your opinion? Maybe it's totally different than mine, of the opportunity and the potential of NFTs.
Yeah, I agree with you. This space NFT is going to be huge, and for multiple reasons. I think in the long term, the bottom line is I see this as the democratization of asset creation for the entire world. Mm-hmm. It's like YouTube is democratizing making videos and filmmaking to the population, to the masses. NFT is democratizing asset formation to the masses. And this is going to have so many different use cases in the many of that you just mentioned. But in the short term, in its current form, what it is, it's a luxury product. It's a exclusive club of a community that is with that particular NFT as its mascot or emblem. It's just like a Louis Vuitton, like a Rolex watch, a digital format of that. If you have a CryptoPunk or a Bored Ape.
Yacht Club. It's kind of like flexing in the community, which I don't know if my members are going to know too well, but you get it.
It's not just flexing. It's also you have access to this group of people, right? So
yes, very strong community.
You have this. There are like a Tesla owner clubs online and offline, and pretty much what type of people will own Tesla. Especially nowadays, it's more mainstream, more popularized. But let's say 3 years ago, what type of people will own Tesla. The Tesla Owners Club are going to be rich, forward-thinking, technology savvy type of people. Basically, people you want to be associated with. Okay. The CryptoPunk Club is the same. For today, it's you are buying your ticket into a elite community of a specific type of people who are going to be the digital elite of the 21st century. Do you want to be part of that? If you want to be part of that, you buy a punk.
For sure. I wish I could afford them now. They go up and up so much.
I wrote a lot about NFTs because I did a experiment a month ago. Basically, I smashed a diamond. I smashed it like a real life diamond. I smashed it with a hammer, and I made an NFT of it. Okay, that diamond was worth $5,000, and that NFT I sold for like a 5.15 ETH.
Which is more than 5,000 for those that don't know.
What's that?
That's more than $5,000 for those that don't know.
Yeah, that's at the time that was like 20K, something like that. But if this sounds crazy to you, I'm not surprised. Okay, but I would encourage you to go on my website and actually read up how that came about and what is the rationale.
On that note, Tasha, because I want to be very respectful of your time, how could people learn more about you and follow you on Twitter? And you mentioned a website. What would be the URL?
The website is tashalabs.com. It's my name, TASHALABS. CHA Labs, LABS.com. And you can also follow me on Twitter. Just if you go on my website, I will link to Twitter, or just find me on Twitter. Just search for Tasha, you'll find it.
I really love Tasha's work. I love her Twitter. I follow it all the time. She also gets tremendous engagement from those that follow her and sometimes disagree with her, especially those maximalists, but we'll save that for a different time. It's really been a pleasure. Look forward to having a much more deeper dive into NFTs in the future. I did mention his name by his nickname before. So Kevin O'Leary of Shark Tank, amazing entrepreneur, great investor. That is Mr. Wonderful. He went from effectively zero to maybe in 2017, dabbling a little bit. He's extremely active in the world of crypto and digital. Through his PR, I almost had him on a couple of weeks ago, hopefully a little later in the year, possibly. I heard him recently state that he puts 40% of his effort on the investment side. And this was not the case a year ago, or definitely not 2 years ago, into crypto and digital. It's the risk, reward, and the potential. Look how flippantly we were saying 50 to 100x or more broadly the ecosystem over 10 years. Hell, we both think that Solana in and of itself could do that. The potential is huge. Is it volatile? Yes. Is it risky? Yes. May we all be wrong? Yeah. I mean, I guess that's possible. Progress stops and revert back to an analog world. I can't say it's impossible. So who knows? So learn more about us. I'm Angelo Robles, host of the Angelo Robles podcast. I'm the founder at Family Office Association. Go to familyofficeassociation.com and learn more about being a member. Follow us. We're active on all mediums, including Twitter. Tasha's a lot bigger than me on Twitter, but I'm not half bad, although hopefully we'll look to get a lot bigger on YouTube. And simply same name actually on Twitter and on YouTube. It simply is at Family Office. So go and subscribe. Look forward to it. Tasha, this has been a great honor and a pleasure. I learned so much and look forward to the next time. Thank you, everyone.
Thank you. Bye.
Bye-bye.